Well, good morning, everyone. My name is Roger Scott. I'm the head trader for Wealth Press. Today is July 13th. It's a Monday. What do I always say? Let's get into it right now. Now, because it's a Monday and this is the first week of earnings, unofficially earnings started about 2 weeks ago, but officially it starts today. So I want to give you a little preview. I want to talk about what we can expect this week and give you a nice little preview of what's coming up ahead. So let's get into it right now. Now, global shares rose Monday, which is hard to believe, especially in light of the COVID-19 cases in Florida. I think we hit an all-time record for the second time yesterday. But we're looking at global economy right now. So cheered upbeat projections for global economic rebound that were tempered by worries over expanding COVID-19 outbreaks. Investors were looking ahead for the release later this week of Chinese economic growth data for April through June, a key indicator for trade, manufacturing, and investing with implications for the entire region. Singapore is also releasing GDP data. Now, that's very, very important. Hopefully, it'll give us some insight into how well other countries are recovering. We got to take it with a grain of salt because it's China, and China tends to fudge their numbers. Investors are hoping for an improved outlook thanks to the reopening of Chinese economy following its own early outbreak. Share prices are much higher than justified by its number, analysts say. And again, we got to be very careful with China because China is it's a slippery slope when it comes to China. Let's just say that. On top of central bank policy meetings in Japan and Europe, corporate earnings are looming, as I said, and I'll get into the details in just a few minutes. According to FactSet, which is does a great job of keeping track of things, estimate earnings decline for the S&P sits at 44.6%. This is in light of positive 8%, which was expected before COVID-19. So it's a whole different world out there. Representing a whole different world. I didn't read this before saying that, compared to the S&P index, which is approximately 6% away from its previous all-time highs. Again, crude oil, 40 cents a barrel, which means energy companies are not bleeding like they were. So again, global market is set to trade higher. Let me show you how the SPY is looking today. Give you some levels on it. We're expecting a nice little strong close. Again, we're hovering around the 50-day line. Let me show you the 50-day moving average. We're hovering right around the 50-day moving average. And let me change this to 200. It's probably more fitting for where we're at right now. There we go. Yeah. That blue line, and I like it better with the blue line. The problem I'm having here is I don't believe the S&P, based on everything I know, is going to get away too much higher from where we are before coming back. And that's because of momentum levels. Earnings are going to be worse than expected, in my opinion. But most importantly, let me show you this momentum level. I know, and I'm about to get into a whole other stuff, but I've been showing you this forever, but you got to see this. This is really important. This is big. Look at this. That's the biggest beef I have, that we're going to be coming down. But again, the stock market could rally from this point on a while longer. But most importantly, keep your eye on this. This is really, really big. Momentum levels are declining. We've never gone this high since we've been keeping record of the number of stocks trading above the 50-day moving average. And if we stay above these levels, we've never once gotten above the 80 percentile without coming down. Look, you could see this. This is a monthly chart, 20 years, okay? And we're going down. But I've been saying that almost every day. Again, I just want to point that out, that the S&P and the NASDAQ is very vulnerable right now. Now, in terms of what to expect this week, we got CPI, we got industrial production. CPI is happening tomorrow. There's nothing happening today. We can expect the market to trade today based on the Asian market, but tomorrow we got the CPI, we got industrial production, we got petroleum report, which is not going to be a major surprise. We know there's more petroleum that we will know what to do with for quite some time. We got jobless claims coming out on Thursday. The expectations about 1.25 million to 1.375 million. As long as we're below the moving average, we're good. We got retail sales, which I'm really expecting this. Remember, retail sales makes up 2/3 of the economy, okay? And consumer sentiment and housing starts. Housing starts is really important because housing starts tells us if manufacturing is bringing up a little bit. Housing starts is big because when people buy homes, they buy things to fill up their home. And then we have consumer sentiment, which is not a major report. So the biggest reports to watch out for this week is going to be the jobless claims, retail sales, Philadelphia Fed Business Outlook Survey, which is huge, industrial production, and housing starts. Housing starts is going to be big. Now, let's talk about earnings, all right? So, second quarter cycle unofficially gets underway this week. From our perspective, the second quarter earnings season has gotten underway already, with results from 19 S&P members already out. These 19 members include FedEx, Nike, Oracle, Adobe, and others. Now, they reported their fiscal quarter ending in May, but it's unofficial, but it is part of the official June through June through September quarter. Sorry. So this week we've got 34 S&P members. We've got IBM. We've got Netflix. We got Johnson & Johnson. For these 19 members, we're looking at a second quarter aggregate net income of down, brace yourself for this, 42% on 5%, 4.8% lower revenue, with 68% beating at EPS estimates, revised lower estimates, and only 52 beating revenue. That's bad because those are revised revenue estimates. This is what I was saying, 68 beating EPS, 52 beating revenue. These are already revised numbers. So if we can't even beat the revised numbers, and they've been revised lower, we're in deep doo-doo. Earnings are expected to be down in double digits for banking stocks, which are reporting starting today. JP Morgan, 51% negative. Citigroup, 77.6% negative. Bank of America, 66% negative. All sectors are expected to have lower relative to a year earlier. Really, you think? With 4 out of 16 sectors expecting to lose money in second quarter, decline in excess of 100%. These are energy, transports, auto, and consumer discretionary. Keep your eye on consumer discretionary because this right here, what you're looking at in the chart, about 40 of these 100 stocks in the NASDAQ 100 are consumer discretionary stocks. And if consumer discretionary is down 115% from the expectations, we are going to see quite a downside. Now, in terms of the stocks, the 10 sectors, we still have technology and consumer discretionary leading ahead. But again, if the NASDAQ gives out, you're going to see this consumer discretionary technology all the way down here, and utilities and industrial and consumer staples and possibly healthcare, because they're defensive, much higher. So I think the earnings that we're going to see is going to be very, very telling. What I'm really concerned about is the fact that the numbers, which have already been revised, are still only 68% supposed to beat EPS and only 52% beating revenue. Folks, remember, we've revised these revenue numbers lower and only 52 are beating these revised numbers. That's very, very bad. So be prepared for potential softness, corrective action, momentum levels declining in the market over the next month, especially if the numbers are as bad or potentially worse than they're expecting. Now, I've got something for you. Folks, Tom Busby and I are at it again. I love the way that sounds. Tom Busby and I are definitely at it again. It all started with an uncovering recording, and now it's turning into something so much larger. Some say we've hacked the market. Oh yeah, it's like that. But all the money is made before the market even opens. In fact, this new pre-market strategy could turn a measly $1,000 trade into over $12,396 in just 1 year. And the best part? This secret can be all yours if you just click on the link below. I mean, folks, Tom Busby and me together again, we've literally hacked the market, or at least that's what it's been said. And notice this analysis that I'm doing, I'm totally giving you the week ahead, what I'm expecting, how I'm expecting everything to play out. Notice I'm doing this pre-open. 90% of all my analysis is done pre-open. Now, I trade after hours, but I select what I do before the opening bell based on everything that happened overnight, things that are completely invisible to you, but not to us because we watch overnight markets carefully, and we know what to look for. We look at the global markets, we look at Asian markets, we look at the US PM markets, we look at the whole cycle, whereas most traders just look at the US market, and that's how you miss the bigger picture. So again, Tom Busby and I, oh yeah, we're definitely back. Get the secret. Click the link below. Get all the info now. Do it for yourself. Do it for your family. I'll talk to you soon. Have a great week ahead. Bye.